Hey guys, so we're probably a long way away from a crash from the looks of it, but it's always good to have a shopping list, as they say. If everything were to sort of suddenly happen, you don't want to be then searching around for what's good, sort of on the basis that sort of growth stocks would fall harder than value stocks. Then sort of the difference between price to earnings ratios of value stocks and growth stocks would be narrower, and it's probably worth sort of maybe getting rid of some of your value stocks or sort of slimming down, having lost less, and go into growth stocks. Even if you have to take a loss on sort of value stocks, if they're down, 10, 20%, and sort of the big growth stocks are down 50, then yeah, they might make a sort of a better option coming out of the crash. So yeah, I thought I'd give a quick look at sort of my watch list, if you like. A lot of you probably sort of noticed that I don't hold quite a few of these really. I do have all of the real estate and industrials. I don't have Deere, but sort of keeping an eye on them. I don't have BT anymore, and Louis Vuitton sort of still a maybe. It's always on the watch list. Food and drink wise, sort of Pepsi, Coke, McDonald's, and that sort of thing, I've always just kept on the watch list. Procter and Gamble and Unilever are always on the watch list. Never really got into Disney and Hasbro. The same. Boeing, Airbus, Rolls Royce. Can't really sort of get on board. And Oracle, I've never really sort of got on board. That one seems to have sort of run away. But yeah, other than that, that's pretty much sort of the watch list and sort of what I do own. I own sort of a few more that aren't on here. But yeah, the sort of change called Doomsday stocks, not necessarily going to be all that bad, but sort of looking at the real estate, I think I'd sort of be looking to maybe lose Taylor Wimpey, Barrett, and maybe Realty Income. Sort of thinking, well, depending if it's a sort of real estate crash as well, they might get beaten down a little bit. I think Realty Income would sort of hold up fairly well. Vici, I think, is sort of reasonably good value, so may not get hit that hard. And then sort of the assurers and primary health cares and that sort of thing are sort of fairly robust. I'd sort of expect those to hold their multiples a bit better. And yeah, Lennar, basically same as Taylor Wimpey and Barrett. Sort of depends on what happens to the housing market, really. Looking at the industry, yeah, so I wouldn't really add any REITs, I don't think. I'd just focus on the sort of more bullish sectors that I think, the sort of data centers, cell towers, and sort of the industrial side. That's sort of where I see the future and where I'd want to be. So I would just sort of probably focus into those. And then industrials, probably lose Archer Daniels, thinking that they would sort of hold up reasonably well. Probably 3M would have to go. Maybe FedEx. And no, I'd probably, yeah, I'd keep Stellantis, VW, Caterpillar, and yeah, Deere would still be on there if it does crash. The two sort of newer ones, Tesla and ASML. So yeah, Tesla, I bought 3 shares now. Can sort of see potential, 3-4 years down the line, what they could be. Don't think they're worth what they are at the moment, but yeah, if they were to sort of crash, then yeah, may load up. And ASML, sort of, yeah, very sort of big company on the semiconductors side. Sort of, they make the machines that make the semiconductors. So they got pretty much a monopoly on that side of thing. But because of that, it's very expensive. So depending on what it did in a crash, might go for them. Energy and infrastructure side, Siemens, I don't think would come down all that much really. And BT, yeah, it's a value stock, so wouldn't really be going for that. But I think I would stick with Shell. They're sort of moving into, in theory, moving into more of the clean energy space. So yeah, I think probably stick with those. Food and drink wise, I think generally does hold up pretty well in the crashes. So I think, you know, as I say, I don't even own Pepsi, Coke or McDonald's, but I don't think those would come down as much as everything else, so I wouldn't be looking at those. And then Tyson and Kroger, yeah, sort of fairly defensive stocks anyway, so may not sort of completely get rid of all of these that I'm not having on this list, may just sort of reduce them and put a bit more focus on the ones that are here. But yeah, Diageo, sort of premium brand, trades at quite high multiple. Did have it before, but I sort of sold it when it ran up a little. Seems to have been a little bit of a mistake really, but yeah, I think I'd go with them. Financials, I think I'd probably get rid of all three, to be honest. Sort of looking back into the past, they do come down in the crashes, sort of pretty much as hard as the market, and you know, sort of sometimes better, sometimes worse, but they don't seem to recover all that well after the markets, and yeah, you don't get that sort of V-shaped recovery depending on what sort of crash it is. I think I'd probably just get rid of all three, to be honest, maybe get back into them, you know, maybe a couple of years, a year or two after the crash. So medical and pharmaceutical, I think I'd leave the same, to be honest. Could be some sort of point for maybe getting rid of Johnson & Johnson if they sort of hold up reasonably well. But yeah, I think sort of just to have a little bit of value in there. And the Arc Medical pie would be probably one to lump into, assuming that gets fairly hammered. A sort of small position overall so far, so yeah, I'd probably go into that reasonably hard if it come down. I expect some of the companies might go bust, but yeah, depending, it'd probably be sort of a gamble worth taking. Mining side, I think I would leave the same, because sort of most of those are going to be based on the commodities, which commodities probably would sort of come down in a crash. Poor outlooks for GDP and sort of building and that sort of thing. I think every day's would come down and sort of would be pretty good, even though they're good value now. Could come down to sort of crazy low valuations. So yeah, I would probably be well in the red on those in a crash, but I think I would try and average down and sort of focus on them a little bit more. So I call it entertainment. I've sort of got Disney and Hasbro as a watch list. I don't think I'd go with Hasbro sort of in a crash necessarily. Just always keep them on the watch list really. But certainly Disney, I think they're trading at sort of far too high multiples for what they're doing at the moment. But I'd be looking at those. Very bullish on sort of the company itself. Probably one of my highest conviction companies, if you like. Sort of really like what they're doing. It's just, yeah, sort of still have an awful lot of revenue coming from cruises and theme parks and that sort of thing. They're not the, you know, it's not one big streaming company as everyone sort of says they are. But yeah, so you wouldn't be paying 40 or 50 price to earnings for them. But yeah, if they come down, then I would go for them. Take-Two, interesting one. I'm sort of quite looking more into them. I used to think they were kind of just more focused on the Rockstar side, sort of Grand Theft Auto and Red Dead, if you know your games. But yeah, the sort of 2K side of them is actually a lot bigger than I realised. So I think they look pretty good. People maybe not pricing in as much of Grand Theft Auto 6 potentially coming next year as they might be. I would be expecting that sort of end of next year. So yeah, I think I would probably go for those as a game company. I don't really own much in the way of gaming specific companies. Yeah, so as I say, Louis Vuitton, if it came down a lot, would probably go into those, the sort of luxury goods and that sort of thing. Just never seems at a price worth paying, but I think I would go for them. And Games Workshop, sort of interesting company, quite small in the UK, but they're sort of selling global, sort of miniature figures, and the sort of Warhammer brand. A lot of the sort of bulls seem to think they can get into TV and potentially even film. Not sure how well that would sort of work out. Sort of past gaming films have been pretty much a disaster all the way through, but we'll see. TV might be interesting. So yeah, I think I would sort of go with them. They're sort of bringing out subscription service as well. So yeah, we'll see. Defence wise, don't think I would be going with Boeing and maybe not even Rolls-Royce. I still want Rolls-Royce just to come back and start making a sort of consistent profit. Assuming sort of Lockheed Martin and Raytheon wouldn't come down all that much. May not get rid of those, maybe just reduce. But would probably be focusing on Airbus. Sort of seem they've got a sort of starting to increase their side of monopoly really on the planes, with Boeing sort of really struggling. And they've also got the defence side as well. So yeah, do quite like the look of sort of Airbus as the company. Just think it's a bit overvalued at the moment with air travel where it is. I know they're sort of still selling planes, but yeah, not really confident on the sector at the moment. And then tech-wise, I guess you've got to go heavy on tech in the crash, assuming sort of a lot of these come down. That was my main thesis, that a lot of these sort of expensive companies would come down a lot harder than the companies that I'm in and sort of some of the companies that I was looking at. So yeah, I think I would probably get rid of Intel, assuming they sort of don't fare too badly. Probably get rid of Oracle, although I haven't actually got those, but they seem sort of not really with the other tech stocks, almost a value tech stock. And then sort of obviously keep the majority that I'm already got and already interested in. May reduce eBay, because I think they would sort of hold up reasonably well in a crash. People still buying second-hand stuff. But yeah, probably sort of keep most of the ones that I've got and sort of maybe go a bit heavier on them. Certainly sort of TSMC and people like that, sort of that high multiple, haven't got very much in them at the moment. Sort of lump a bit harder into them, probably the Chinese techs as well, and certainly Samsung. And the FANGs, so you probably notice, as I say, I haven't got any of the FANGs at the moment. Sort of Microsoft, Google, Apple and Amazon. Yeah, I call sort of Microsoft instead of Netflix in the FANGs. Netflix sort of quite a small company in comparison now. But yeah, so not having an S&P 500 tracker or a NASDAQ or anything, I have no exposure to them at all. Just sort of think they're a bit high to be paying at the moment. But if they sort of came down, then I'd probably be looking at all four of these. Fairly sort of bullish on all four of their business models, to be honest. Probably Apple the least. I can see they have sort of started growing recently in the last year, but sort of before the last year, really, they were kind of a little bit stagnant, sort of slightly growing profit, slightly faster growing revenue, but not the sort of massive growth stock that people were painting them out to be. But yeah, the last year has sort of got a fair bit better. But yeah, certainly bullish on sort of the other three. You notice Facebook's not there. Really not sort of keen on Facebook. See the sort of Facebook itself, the platform, just getting less and less popular with sort of younger people, popular with sort of the older generation, and supposedly the advertisers love it. But yeah, I think if you're not getting the young eyeballs there, then just not very sort of confident on the long term. And all sort of the bulls ever go on about is it's all about Instagram, and sort of Instagram's like a quarter of the size of Facebook. So yeah, just sort of can't see paying for the stock essentially just for the future of Instagram. And of course WhatsApp, which is free, don't really sort of see the idea in that. It was sort of fairly big when they bought it, and yeah, it's expanded, but still no sort of monetization. So the only way they can really be sort of making decent money out of it is using the data, which sort of don't really want to put my money behind, to be honest. So yeah, that's my thoughts on the FANGs. Would probably go into those four, and yeah. So this isn't sort of necessarily what 100% of what the portfolio would look like, but it's an idea to be sort of having a crash watch list, if you like, and then you sort of assess each of these on their own merits, and maybe sort of stick to, you know, some of the existing ones that you've got, depending on how they perform. So yeah, I'll leave it there, and we'll maybe have a look at the ETFs.